Imagine making money when stocks go down, like in the red line here. But here's the catch. One wrong move and the losses are limitless. Intrigued? Today we're diving into the strategy of short selling, where high risk meets high reward and one misstep can break the bank. If you want to know how traders profit when share prices fall, or why big hedge funds sometimes lose millions going short, like with GameStop, stick around. This strategy is one of the more dangerous ones out there, but it can really smooth out your profits. To start, let's define what short selling actually is. Unlike a typical investment, where you buy low and sell high, short selling is the opposite. You sell high first, hoping to buy low later. Basically, you're betting that a stock's price will drop, allowing you to buy it back cheaper and pocket the difference. Let's take an example to clarify. Imagine you believe a stock trading at $100 will soon fall. You borrow a share and sell it for $100. Later, if the price drops to $70, you buy it back, return it to the lender, making a profit of $30. Simple, right? But there's a lot going on behind the scenes. To short a stock, you don't just sell it, you actually need to borrow it first. Brokers handle this process by borrowing shares from other clients or institutions and lending them to you. This involves fees, which we'll cover shortly, but the key here is that you're using borrowed assets, which adds unique risks. The fees are really important. Short selling has a major downside. Unlike buying a stock where the most you can lose is what you invested, losses when shorting are unlimited. If a stock price surges instead of drops, your losses grow exponentially. Imagine shorting a stock at $100 and it goes to $900 for some reason, like GameStop for example. You've lost 9 times what you invested. Oh, 8 times. So here's an example of the short system. In red there, the blue is the S&P 500. Now it does well, obviously, when the S&P 500 does poorly, such as in COVID and the GFC, but actually it's done well in 2023 and 2024 also, while the S&P 500 has also gone up. Now the returns overall are not great, but they never are for short systems. But what's great is it can smooth out your overall portfolio by adding a short system into the mix of your systems. The trick though is in the details, particularly borrowing costs. Now listen up and I'll talk more about those. So to find the borrow rate when you're selling short a stock, go to your broker. So here on Interactive Brokers, for example, you go to the portal, then in the site search here you type in SLB for short stock availability down here. Then you just type in a symbol, say CAT for Caterpillar. I think it's on the New York Stock Exchange, search. And you've got all the bonds, but you just pick the stock there, it's already picked. Continue. You can see here the current fee rate, that's 0.4% per year, right? So nothing to worry about. Now if we pick a stock that's illiquid, because the high rates are normally with stocks that aren't traded very often. Red Hill Biopharma. Look at this, 239% per year. If you short Red Hill Biopharma, you will lose 239% per year. And this is not a joke, because I actually did it by mistake. And I checked my brokerage account a month later, and yeah, it wasn't pretty. So you have to check the fee rate, the borrow fee rate, before you short stocks if you don't want a surprise. With really liquid stuff, it's normally fine. It's like normally less than 1%. But with illiquid stuff, you can see they're just absolutely brutal. Before we dive deeper, if you're finding value here and want more insights into advanced strategies like short selling, consider subscribing. We're building a community of sharp, informed investors and we'd love to have you with us. One hidden cost is dividends. If the stock you're shorting pays dividends, those payouts go to the original shareholder, not you. This effectively means you as the short seller have to cover that dividend payment, increasing the cost of holding your position. Now let's talk about short squeezes and the intense volatility they can create, perfectly illustrated by the GameStop and AMC stories. In a short squeeze, the price of a heavily shorted stock suddenly skyrockets, pushing short sellers into a corner. When this happens, short sellers scramble to cover their positions, meaning they rush to buy back shares to limit their losses. This unexpected buying demand causes prices to surge even higher, intensifying the squeeze and what's often called a snowball effect. During the GameStop saga, this effect was amplified by retail investors on forums like Reddit's Wall Street Bets. These investors recognized that hedge funds held massive short positions on GameStop and coordinated to drive up the price, catching major institutions completely off guard. As the stock price soared, hedge funds were forced to buy back shares at huge losses, sometimes in the hundreds of millions in some cases, triggering a chain reaction that made headlines and altered how many view short selling in the market today. The event sparked debates on market fairness, regulatory gaps, and even the power of collective retail trading, showing just how powerful a short squeeze can be. You may have also heard of naked short selling. No, that's not short selling with your clothes off. Unlike standard short selling, this illegal practice involves selling shares without borrowing them first. This can artificially drive prices down and has led to fines and regulations. As a retail trader, it's not something to worry about, and it's not even an option, but it's worth knowing as part of the overall market landscape. One way to manage the risks of short selling is through using stop orders. Stop orders can help limit losses by automatically closing the position if the stock price rises beyond a set threshold. Now, I don't use stop losses in any of my long systems where I'm buying stocks, as you can see in the video up here. But for short selling, you have to. And I've done a lot of back testing on short selling systems, and the potential losses if you don't have stops in place, you don't want them. You gotta use stops when you're shorting stocks. You just have to. Otherwise, they can take you out in a stretcher. Short selling is generally for advanced traders due to its risks and complexities. For beginners, understanding short selling is crucial. Practice in a simulator with very small positions before using real money. And check your brokerage statements so you make sure you've calculated the borrowing costs correctly, so they're not a surprise to you. Remember, even seasoned investors can get burned by sudden market movements. So there you have it, the fundamentals of short selling and why it's both a high risk and potentially high reward strategy. If you found this breakdown helpful, please join our Patreon channel, linked below, where I do private coaching, and subscribe for more insights. Let us know in the comments if there are other topics you'd like us to cover. Thanks for watching, and see you in the next video. Up there!